Agency versus banks versus debt funds and multifamily lending explained. And when financing a multifamily property, investors often face with three primary options: agency loans, bank loans, and debt funds. And each loan type will serve a different purpose and can significantly impact your returns, flexibility, and long-term investment strategy. Understanding the differences between these financing sources can help investors secure the best loan structure for their specific multifamily acquisition, refinance, or value add project. And with access to over 700 lenders through CommLoan's technology platform, borrowers can compare multiple financing options efficiently and identify the best fit for their investment objectives. CommLoan's marketplace provides access to banks, debt funds, agencies, credit unions, life insurance companies, and other commercial lenders. So, what are multifamily loans? And agency loans are backed by the government sponsored entities such as Fannie Mae, Freddie Mac, and HUD. And agency lenders will specialize in stabilized multifamily properties and are often considered the gold standard for long term apartment financing. So, agency loan advantages. Well, you're going to have very competitive interest rates with long term fixed rate financing, but also non recourse financing that's available and with higher leverage options. And interest only periods are available. So, let's talk about some agency loan disadvantages. Well, you're going to have more documentation required with an agency loan with a longer approval timeline. And you will should expect a prepayment penalty, and there will be property stabilization requirements. So really, these are best for stabilized apartment properties and long-term investors with buy and hold strategies and large multifamily portfolios. So what are bank multifamily loans like? Well, banks and credit unions remain one of the most common financing sources for multifamily investors, and these lenders generally keep the loans in-house and can offer a little bit more flexible underwriting based on local market knowledge and leverage their borrower relationships. So bank loan advantages. Well, you got a little bit more flexible underwriting, and it's usually a relationship-based lending type deal with lower closing costs and easier refinance options. And typically, you might see some shorter prepayment penalties. So, what are the disadvantages of bank loans? Well, they're often with recourse, and their variable rates. And their fixed rate period may be long enough for you, may not be. But usually there's a shorter loan term, and there's balloon payments that are common. And these are best for local investors in smaller multifamily properties and owner managed portfolios and borrowers who seek flexibility. So, what are debt fund multifamily loans? And debt funds are private investment groups that basically provide commercial real estate financing outside the traditional banking channels. And they focus heavily on speed and leverage and execution. So, some debt fund advantages. Well, you should expect a little faster closing with higher leverage and flexible property conditions. And these are really ideal for transitional assets. Interest only options can be available. So, what are some disadvantages of a debt fund? Well, you're typically going to have a higher interest rate with a debt fund and usually more fees and potentially a shorter term. And usually they're really intended as a bridge financing tool, so from point A to point B. What multifamily loan option is right for you? Well, that answer really is going to depend on your investment strategy. So you would choose agency financing if you want a long-term fixed rate and your property is stabilized and you prioritize low borrowing cost. You would choose bank financing if you want flexibility or if you value a relationship with your lender or if you need customized underwriting. And you'd choose debt fund financing if speed matters, if the property needs renovations, and traditional lenders cannot execute quickly enough. So let's talk about why investors use CommLoan. And commercial lending remains highly fragmented with hundreds of lenders and thousands of loan programs available. And CommLoan's technology platform helps borrowers compare financing options across a network of more than 700 lenders, helping investors identify competitive solutions without contacting individual lenders one at a time. So whether you're purchasing a multifamily property or refinancing an apartment complex or funding a value add renovation, having access to multiple lender types can dramatically improve your financing outcomes. So final thoughts for the day: that the best multifamily loan is not necessarily the one with the lowest interest rate. And successful investors evaluate the overall loan structure and recourse requirements and prepayment penalties and future refinancing options, and also their alignment with their business plan. And by understanding the strengths and weaknesses of agency, bank, and debt fund financing, investors can make smarter decisions and maximize their long term returns. And for multifamily financing options nationwide, contact Bill Rapp at the CommLoan and Power Program to compare lenders and identify the right solution for your next investment. And that, my friends, is it for the day. Please visit my website, billrapp.comloan.com. You can start a pricing quote and schedule a consultation so that we can have a conversation. And thank you for watching. Have a good day.